Be more selective in terms of sports rights. What does that mean?
Well, again, it means saying no to things that don't deliver the value and saying yes to things that do. We're very grateful and pleased that we have a new long-term NFL deal, extremely important, with basically more product than we had before. More games postseason, the Super Bowl, for instance. We've got great rights license agreements in college sports. We have an NBA negotiation coming up.
How's that going to go?
Well, you're
at $1.4 billion, I think, a year. People say that could double.
It's a very, very valuable property for this company. It's a great sport. And not only is there a lot of volume, there's a lot of quality, and it would be a priority of ours to extend our deal with them.
But with sports rights going up, Bob, as they seem to, and with the number of people paying you each month for the linear product, at what point does it get out of balance and you say, you know what, we've got to take this thing fully over the top?
Well, I think the model ultimately will change. I think it will become an over-the-top model. I said yesterday I don't know when that will be. We've had conversations about it. I actually think as a so-called over-the-top model, a streaming model, will be a phenomenal product for the sports fan, because it'll give them more flexibility.
They have to pay a lot for it.
Well, I think pricing is obviously something we have to look at very carefully, and a combination of or balance of pricing and how many subs do you need to have it make sense in terms of the bottom line.
So one day ESPN will be sort of largely a streaming service?
One day.
But that day is not here. Do you know when that day comes? Does whoever succeeds, you're going to know? Like, when do you just see it coming? Like, okay, that's it. We can't afford this anymore. We've got to try something else.
I think if you do the math, you've obviously done the math.
Yes.
I should turn the question on back to you. If you do the math, there's an inevitability to it, I believe, but I can't say when. It will, and we're not going to do something that's either precipitous or reckless in any way. We'll time it right.
Speaking of math, I want to get to some numbers. The company has not been generating a lot of free cash flow. In fact, your negative free cash flow a significant amount recently. You only did $1.5 billion last year. Is that a concern to you at all?
Well, most of it has to do with COVID. If you look at what happened in March of 2020, other than streaming, every one of our businesses basically shut down. There were no live sports, no movie going. Our parks shut down. Our cash flow basically ceased.
Although this year you're not going to generate a lot of free cash either.
No, we're still recovering from that, and we're still obviously losing money on streaming, and obviously that's one of the reasons why we have to turn that around. But as we said on the call yesterday, we're going to get to a point where we're going to recommend to the board a dividend at the end of the year. Mm-hmm. That suggests some confidence in our cash flow directory and how we not only generate capital, but how we allocate capital.
How do you have confidence in, when you put out a number of $5.5 billion in cost cutting, $1 billion of which is already underway, what gives you the confidence you'll get there to the extent you can say, hey, we are going to reinstate a dividend?
Well, not all the $5.5 billion in cost cutting will hit us right away, because some of the content is baked in. We've made commitments to it. But we're starting today to achieve that number and to achieve the number that we set on what we call SG&A, general expenses. So a combination of that, a combination of continued recovery from the pandemic. We talked about our parks and resorts results as for instance. It was a phenomenal business for us, higher margins, I think real growth potential in the future, including our cruise ship business, where we launched a new ship, and that business has been fantastic. When you look at recovery, by the way, it's an amazing story.
We have so many things we haven't yet gotten to, including the parks. But
we think we obviously have confidence in our ability to grow free cash flow over the we'll call it next 5 years or so. Some of that will come with obviously turning a business that has not been profitable into a business that's profitable, streaming.
Right, which again by the end of 2024 it will be.
That's what we said yesterday.
I heard you.
I haven't changed my opinion on that today.
Good. I'm glad less than 24 hours hasn't changed. In 2024, there's something else coming up, and that's Hulu. You didn't get any questions about it yesterday on the call, but that could be a $9 billion bill to you if my parent company puts their interest to you as they are able to. If you were to buy that, that would take your leverage up significantly. Some question whether that would be a good strategy. How do you view it?
Well, first of all, our leverage is not a huge concern to us right now, not the concern that others would suggest that it is. That said, we are intent on, over time, reducing our debt.
Well, you have a lot of fixed costs. I mean, you get up to leverage of 4 times, let's say. People do get concerned. You have a high fixed cost
I would
business.
imagine that would be at a time when our other businesses are starting to generate more free cash flow. But I'd rather not get more specific about that because we're not really, we're not prepared to give any forward statements in that regard, for instance. But I've talked about general entertainment being undifferentiated. Hulu, by the way, is a very successful platform, and I think a good consumer proposition. But everything's on the table right now. So I'm not going to speculate about whether we're a buyer or a seller of it. But I obviously have suggested that. I'm concerned about undifferentiated general entertainment, and particularly in the competitive landscape that we're operating in, and we're going to look at it very objectively.